All right, welcome back to accounting here. So we are going to be diving into breaking the business down into certain sections, okay? So we're going to be starting to look at periodic inventory, right? We need to purchase our inventory before we're able to sell the inventory, right? So that's exactly what we're going to be looking at is starting to break down the business and start from how we actually generate our money. We got to buy the product first. So, in this case, just a quick review here. We are focusing on a specific type of business activity, which is merchandising, where we are going to act as if we are a retail store, right? Where we're buying products that are already been made, and our job is to resell it. So first thing we got to do is we need to be able to purchase the inventory that we are, potentially selling. So merchandising inventory. All right. So once again, what is inventory? Well, inventory is going to be items that you are buying with the hopes of reselling. Now, when you sell it, right, of course, you're trying to also gain a profit out of it. So that's the purpose of what a lot of the industry is currently right now is they are currently a reseller or a retail store, right? Where you're constantly going to that store to buy products from a specific company, right? So of course, when we take a look at what inventory does, what are what are things that basically become inventory? Well, inventory is considered a current asset, right? It's where we're purchasing something, right, an item, and we have ownership over it until we decide to get rid of it out of our books, right? That's where we convert that asset and we convert it into cash. All right. So here is a scenario where this is what we're going to do, right? We are going to be converting cash into goods, right? We buy the products. Then we take that goods, right, and we convert it into sales. And when we convert that sales into, or when we convert the goods into sales, we gain money or gain cash from that sales. Okay, so that's the idea of how a merchandising operations work is that's what we do. We buy products, we have the intention to sell it, and then when we sell it, we gain money out of it. So we spend money to buy the products, and at the end of the day, we should turn it around and be able to sell it to make a profit and also to receive money from it. So again, typical operations are going to be retail stores or even wholesalers, right? So if you've again, looking at trying to sell in bulk, right? Usually those wholesalers will sell in large quantities, in bulk. Okay, so they have the same functionality, right? They will just sell you more product into one sitting versus selling them at a individual level at a retail store. Okay, so that's our main goal is purchase our goods, right? And find a way to successfully convert those goods into sales, okay, and get money out of it. So what's going to be considered as a part of merchandising inventory? So when we understand this, right, it costs us money to get the item to our store. So the idea here is every single cost it takes the inventory asset to get to our store is going to be things that are you're going to be considering as the cost of the goods that you sell. Okay, so for instance, right, especially when you're purchasing items, you're going to purchase them at whatever um, price that it's being sold for, so the price of the product. And if there's anything, so again, if it's a product that you are buying in store, you're more likely to have to be charged sales tax. But what a great deal, or sometimes you can be tax exempt, is if you are a retail type of store. Well, now, of course, anybody can say, yes, I'm my own small business. I'm planning to resell this product, right? You do need to also build a relationship with your vendor to exchange things like proof that you are a legitimate retail business for you to get tax exempt, okay? Because again, you're also dealing with the government in this case, right? Because sales tax is a mandate, right? You are obligated to have to charge sales tax. But in this case, if you are a legitimate proof that you are a retail store, right? Vendors or suppliers can tax exempt you because they don't need to collect sales tax from you because you're going to be collecting sales tax from your customers. So we call that use tax, so USE tax, and that's basically you're transferring the tax from one company to another and basically giving the responsibility to collect the tax from someone else, okay? So again, that's going to be something that you can be taxed or may possibly be tax exempt for, okay? Other things is getting the items to your store, right? So if you're ordering in bulk, usually what happens is they get shipped to your store. So freight expense is going to be something that you are going to consider, right? If you're trying to get it faster to your store, you might have to pay some expedited costs, okay? Others, like if it's a fragile item, you may have to pay additional costs for shipping and handling, right? Especially if you're buying products that are, easily breakable, right? You may have to pay an extra additional for them to package it even, so it doesn't break during shipping, right? And if you also need to pay some storage fees or foreign costs to bring it over from one country and importing it in, then again, those are all going to be considered costs of the actual inventory itself, okay? So we have to understand, because this is going to be how we calculate our cost of goods sold. Every single cost it takes to get the inventory asset to your store. So again, if you're buying it from the store, right, you need the selling price and the sales tax, because again, you could just drive it to your store. But if you're ordering it online or ordering it through a manufacturing company directly, then other costs such as shipping and handling are things that you also have to include the price of the inventory. Okay? So let's talk about how shipping actually works and how ownership excuse me, is being transferred from one title to another, okay? So when we actually talk about shipping, you actually have to understand that shipping is a two-way process, okay? So we have goods in transit, right? And we have two types of ways that the inventory is coming from the the seller's store to the buyer's store, right? The first point from the seller's store to the midway point, we call that FOB shipping point, right? It's going from the seller's store and it's being shipped to the midway point. Now, when this happens, what happens is the buyer is responsible to pay the shipping between from the seller's point to the midway point. So they're responsible to pay for shipping for FOB shipping point. So shipping is actually twice as much, right? Though when they charge you for shipping online for online orders, they're only asking you to cover for the half of the shipping, because shipping is actually tremendously expensive because you're carrying it from one place to another, and it can be through traveling through a train, an airplane, or a truck, right? There's so much extra cost that actually goes into it. So they're requiring you to cover as a buyer, right? To cover the cost it takes to get from the seller store to the midway point. And we call that FOB shipping point, okay? Once it crosses here, right now, the seller still has property over the items here, okay? Once it gets from the midway point all the way to the buyer's store, okay? This is where transfer of ownership actually gets transferred, right? Because as soon as the items reach the buyer's store, right, it's now the buyer's property. It's the buyer's merchandise now, right? The transfer of ownership has been transferred between the midway point to the buyer's store. We call this FOB destination. Now, between the midway point to the buyer's store, right? The seller is responsible to cover the shipping cost. Okay? So, for instance, Amazon, right? When a package is being delivered to your home or your office, right? What happens if that package becomes lost? Who's responsible for that? The seller is, because remember, the seller is responsible to cover the cost for FOB destination. So if the items never get to the buyer's store, then it's the seller responsible because they were the one who paid for the shipping between the midway point to the buyer's store. So that's why oftentimes, right, it is a customer policy as well that, oh, if you're unsatisfied with the product that you are, you can ship it back and you can get your money back guaranteed. Now with Amazon, right, they if they lost their package, usually they update you. But oftentimes is if you don't like the product or it never gets to you, they have options to either refund you the money or replace the item and ship you out a new item. Okay, so they do have that option, and that's exactly what this concept is displaying right here, is that if you do not get your product from the midway point to your store, the seller who sold you that product is responsible to pay or to reimburse or to distribute a new item. Okay, but usually when you pay that shipping and handling, that's to cover the FOB shipping point from the seller's store all the way to the midway point. Okay, so that's a little fun fact for you guys to know. And there are two types of shipping. FOB is freight on board. Usually freight on boards are usually company related. So if a company is selling you the product, FOB usually is attached as a part of their delivery services. Where you have COD. COD is where a company usually they have a third party vendor that helps ship out packages. So again, Amazon, right? Amazon, even though they have their own Amazon truck, they're also using the Postal Service, UPS, and FedEx to help distribute the packets as well. So again, that is an example of an FOB and a COD, right? It's multiple parties distributing the product around. Okay, they don't have their own type of shipping company. However, even though Amazon does have that FOB, right, because they have their own Amazon truck, depending on where the package is coming from and what delivery services that they use, typically you don't ever see COD because you already paid when you paid for the product. Okay. COD is usually when they do deliver to your store and they require you to sign and they require you to pay up front for the items for you to also ensure that you did receive the items, right, by paying a certain amount to that third-party vendor. Okay. So let's talk about inventory tracking methods. Okay, so there are two types of inventory tracking methods. You got periodic inventory and you have perpetual inventory, okay? Now for this class, I'm actually going to split these two concepts into 4 different chapters, okay? So chapter 5 and 6 is going to be dealing with periodic inventory, while chapter 7 and 8 is going to deal with perpetual inventory, okay? So we will get to visit both methods of how we keep track of our inventory. But for now, we're only going to be focusing on one tracking method first, and then we will go ahead and take our exam, and then when we come back from our exam, we'll go ahead and complete this second half of the inventory tracking method, okay? So in this case, right, we'll be testing on periodic, and you're going to see the similarities yet differences when we actually do the perpetual inventory in chapter 7 and 8, okay? However, I do need you to know the difference between and what they hold and what the difference is for now, but I want you to focus on periodic inventory because that's the one that we're going to be focusing on for chapter 5 and 6, okay? So here's the first thing is when we talk about periodic is what is the definition of periodic? It's pretty straightforward, right? Exactly what the real definition is. Periodically, you're doing it every once in a while, right? You're doing it periodically where you're checking it here and there. So it's not constant. It just happens, occasionally, right? You're not really keeping a really good track record on it. You're just checking it up every once in a while, okay? So with this kind of idea, what happens is that you are not really, again, keeping a really close attention to how many items that you have on hand at all times. So this type of tracking method, right, requires an actual physical count, right, of inventory. So usually at the end of the day, when you close up the shop, normally you have someone to go down to the inventory or the warehouse or down in the basement in your store, right, and take a quick physical inventory count so you know how many items you have available to sell the next day, but also to kind of get a rough estimate of how many items that you have sold during the day. So that is a huge factor that you need to understand is that it usually happens at the end of any given accounting period, right? So if you choose to do an inventory check every day, then the end of your given accounting period is at the end of every day. Okay. Now again, if it's an item that you don't really care to keep track of very closely, you can do it at the end of the week or even at the end of the month, right? Depends on what kind of item that you have, right? If it's something that you do sell occasionally on the daily, then I do recommend you to do a physical count every day. But if it's an item that you sell maybe once a month or maybe twice or 3 times a month, then that's something you might want to consider doing at the end of the month, right? Because you know for a fact that you're only selling 1 or 2 items roughly every month, okay? So that's something that you don't want to have to keep track of all the time because you already can kind of guesstimate right there that it's not something that you want to really keep track of. So again, an inventory physical count is necessary when we are using periodic inventory because that's going to tell us, number one, how many items we have on hand at all times, and it also tells you roughly how many items that you have sold. Okay? And of course, when we actually dive into journalizing for the purpose of inventory, the first thing we're going to do is we're going to recognize them as expenses, okay? We do not recognize them as inventory, right? And the reason that's because, again, it's not something that we keep a good track record of. So therefore, we're going to consider them as expenses first because, again, at the end of the day, you're going to end up getting rid of them anyways. So there's no point to keep a really good track record of them. Instead, we want to keep them as an expense. However, once you reach the end of the accounting period and you have leftover inventory, that's where you're going to be required to have a conversion entry to convert your expenses into inventory, okay? And we'll talk about that in chapter 5.4, which is tomorrow, okay? So in this case, right, when we think about periodic inventory, we are going to treat our purchases of inventory as expenses, okay? Whereas the difference between that, right, you have perpetual inventory, which literally means constantly, right? You're constantly updating your inventory, you're constantly updating your sales, you're constantly, every time you sell a product, you're constantly updating your inventory because you sold your products. You don't have them in your inventory anymore. That's the huge difference between periodic and perpetual. Is one is that you don't check all the time, and then a physical inventory count is required. While if you're using a perpetual type of inventory, you should know how many items you have on hand at all times, because you're constantly updating every time you make a purchase. You're updating your inventory. Every time you sell a product, you're updating your inventory. So in this case, you can do a rough physical account of all of your inventory items that you have on hand to ensure that when you have sold an item, or for instance that you match your numbers. But in this case, it's not required all the time, just because you should, if you're keeping a really good track record, you wouldn't need to have to know how many that you have on hand, because you would know immediately. Okay? So that's a huge difference. Now, whether you do it on the daily, weekly, or bi-weekly, at the end of the day, you would know how many items you have on hand at all times, right? And here's the difference. All purchases are going to be immediately recognized as inventory, which is an actual current asset, right? So in this case, it's another difference here is periodic, you're recognizing them as expenses. Perpetual, you're recognizing them as assets, okay? So any questions so far? Any questions?
No.
Okay. All right. So let's actually dive into periodic inventory, okay? So now that we know that, since we're going to be focusing on periodic inventory for chapter 5 and chapter 6, so now let's actually take a look at how we actually purchase our periodic inventory, okay? So here is an example that on July 1st, XYZ company purchased 100 units of toys from Toys U, okay? And of course, it cost them $5.65 each toy, and freight costs a total of $100, okay? Purchase was made on an account, okay? So there's a familiar word there. And so let's go ahead and record this transaction. So for this class, okay, since there are infinite amount of costs that are related to purchasing your inventory, right? I'm only going to use two, okay? We're going to be looking at a purchase expense and a freight expense, okay? Now, if you remember from earlier that I've spoken to you, right? Sales tax is going to depend on what you're buying. If you're going to go to the store and buy it, you're going to be charged sales tax. If you're purchasing it through a legitimate supplier or vendor, right? They will make the executive decision whether they will charge you sales tax or not. So in this case, as a supplier to a retail relationship, I'm not going to have sales tax include here. Okay? So that's why, again, I'm not going to put in foreign tax or shipping and handling tax, right? I'm only going to have you guys only learn purchase expense and freight expense. Those are the bare minimum. But that doesn't mean you can't have any of the following above on that list, okay? Because all of those are going to be included in the price of inventory. So in this case, I'm only going to include purchase expense and freight expense, okay? So again, how do I journalize this? Now, since we are making an expense, right? Because that's what we have to recognize our periodic inventory as, right? We recognize them as expenses. So in this case, we are increasing our expenses, which are normally increased with a debit. And then because we are placing it on an account, we recognize that is a liability, right? So therefore, it's going to be under an accounts payable, which is a liability. And since I'm increasing the amount that I owe for this vendor, since I'm not paying it right now, it's going to increase on the credit side. Okay? So first things first is we're going to recognize what is your actual purchase expense. Well, what did you buy? you bought 100 toys that cost you $5.65 each toy. So in this case, you're going to get a grand total of $565. Freight cost you $100. So in this case, that's exactly what you're going to do. You're going to figure out one thing at a time. So my purchase expense, like I've mentioned, right? I purchased 100 toys at $5.65. So therefore, you can't put 100 toys in your journal. You have to put the total value and the total cost. So in this case, 100 times $5.65 will give me $565. We're going to recognize your freight as a separate expense. Okay? So here's my freight expense, and because it says that it cost me $100, there you go. I put my freight as a separate line here, right? And I placed it all on an account. So therefore, the vendor is going to bill me for my purchase of inventory, right? So that means I owe this vendor money. Okay, so XYZ company will owe Toys U some money. And here's the rule of thumb here, right? Because it's placed on an account, my total debits will equal my total credits. And that means we owe Toys U a total of $665. Okay? So that is purchasing. Any questions? Okay. So now that we learned how to make a purchase, right? Now the purchasing is very straightforward. So once you've learned how to do one purchase, it's just rinse and repeat from there, right? Every single time you make a purchase, this is exactly the formatting of how you should journalize it, right? Now, of course, if you're able to purchase, you also have the ability to get a purchase discount, okay? Now, when we talk about purchase discounts, right, this is what we have to understand, is that depending on who you are, whether you are the supplier or whether you are the customer, we have this which is called terms. Terms could be used as many different ways, right? But mostly terms usually tells you what is the amount of time that a bill is due. Okay, so for instance, right, if we owe money to a specific vendor, they will give us a term of net 30, meaning you have 30 days to pay this bill off, right? Now, what if they decide to throw in a percentage? What does this percentage represent? This percentage basically represents as a way to give incentives to your customers or to whoever is receiving the bill, and giving them incentives to pay back quicker, and by doing so, you get rewarded with a discount. So for instance, normally you would see something like this, 2%, 15, net 30. What does that mean? This literally means that you're going to be taking a 2% discount if you pay the vendor within the first 15 days. If not, you have 30 days to pay the entire bill off, okay? Now, do not confuse this, because it's not the first 15 days and then you get an additional 30 days, right? The entire bill is 30 days. But if you pay within the first 15 days, so the first half of the month, then you are going to be rewarded with a 2% discount. But at the end of the day, if you choose to pay within the last 15 days of the month, then that's it, right? You don't get the discount, unfortunately, because that's the condition. You have to pay within the first 15 days. If not, the entire bill is due in 30 days, okay? So that means you have a whole month to pay for it. Now, this is considered a standard term. There are date-driven terms. So, for instance, if a bill is due specifically on a specific day of every single month, then that's what a date-driven is going to be considered, a date-driven term. But we won't actually take a look at date-driven terms until we go into QuickBooks. Okay. So in this case, right, this is an incentive to get paid quicker. Now, as a vendor to a retail relationship, right? Since we are buying in bulk, we are most likely going to be paying thousands and thousands of dollars because we're buying a majority chunk of the supplier's supplies, right? Their items, right? We're buying hundreds and even thousands of their product. So in this case, we're owing them a lot more money. So they're giving us an opportunity to take a discount off of those items, but the idea is that we have to pay them back sooner. So again, if you have the funds, go ahead and pay for it. If you don't, then you just wait till the day comes, and then if you have enough money, then you can pay them. If not, just you have 30 days to pay them. Okay? Now, terms can come in different forms and different numbers. So you could see 1% 10 net 20, 1% 10 net 30. Okay, so again, terms are going to be flexible into regards to how much of an incentive you want to give the people who are receiving the bill. Okay, so there are two ways that we can record if our supplier does give us terms. Okay, you have the net method versus the gross method. Okay, so let me elaborate what they are first, and then I'll give you a more clarified example. Okay, so in this case, so net method, right? Usually net method are for those major companies who have sufficient funds that are able and capable to be able to pay off the bill almost instantly, right? Or someone who's really good at managing their bills. They're more likely to be saying, hey, you know what? You give me 10 days to pay off and get the discount. Great, I can pay you within the next couple days or within that week. Then that's going to be something that you want to use the net method for, where you are purposely taking the discount into account and going ahead and processing it at the discounted price. Okay, so in this case, with a net method, you're taking the discount immediately. So again, you're recording the purchase of the items at the discounted price. Where gross method, right? So for example, most startup companies or small businesses, there's definitely a lot more expenses and a lot more priorities that arise that should be paid off first. So in this case, right, even though you were given an incentive, again, you have priorities where your money needs to be paid off first. So in this case, it's a matter of fact of determining whether you have the sufficient funds to even be able to take advantage of the discount. If not, then you're most likely going to have to miss out on that discount and just record it normally. So in this case, you will have to wait till the condition is met, right? That if you pay within the 15 days, then you can take the discount out. So in this case, you're going to record it at regular price, and if you pay within the discount period, then you go ahead and recognize that the discount has been made. But if you choose not to and miss the discount, then all you had to do is just pay for what you owe. So that's the huge difference there. Now think of it like your paycheck. So that's the exact example I'm going to talk about, is think of your paycheck, right? When you work for a company, they give you a pay stub that lists out all the items that you are being subject to pay taxes to, right? The very first line is your gross income or your gross earnings. That is what you have earned for working at the company. And then as you go down and take out all the taxes, then you're going to get your net pay at the very end. So that's the same idea. Gross is what you start out with before taxes. Net is what you get after taxes. So that's the same idea. Gross is you're going to record it at regular price before the discount. Net method, you record it at discounted price. So you take the discount out immediately. All right? So that's the same idea here. Okay? So let's go ahead and take an example of the gross method. Okay? So in this case, right, here we're looking at a purchase here where we purchased something on February 1st. Okay, you purchase 100 coffee mugs on an account from Cuppy's Co. Okay, and it cost you $1.25 each with the freight of $100. Terms are 5%, 10, net 30. Record this transaction using the periodic inventory. So again, we're using gross method. So we're just going to recognize what the full price of the product is because, again, we must meet this condition in order for us to recognize the discount. So that's what gross method is, right? We take the discount later. So in this case, we record that February 1st, we got a purchase expense of $125, right? 100 mugs at $1.25, plus the freight of $100. That means I owe on an account a grand total of $225, right? That's the gross price, okay? So scenario 1, what happens if a couple days later, it's now February 9th? Since the terms was 2%, 10, net 30, right? Did I meet the condition? Did I pay within 10 days? Right? I purchased them on February 1st. So again, in this case, it's February 9th. So 9 days later, we decide to pay. Okay? Now, in this case, if I waited 9 days later, then yes, I made the discount due date, discount period. So in this case, right, I now need to record the payment because remember, it's a condition. You have to pay in order to receive the discount. So this is where we're going to understand that, okay, now that I already recognize that I received my inventory, I need to pay for what I owe. And what we recorded earlier was that we owed on an account $225. But because I paid within the first 10 days, I now need to recognize a purchase discount. And that means when I pay the vendor, I'm not going to pay for them for what I owe them. I'm going to pay them less because I took advantage of the discount of that 2% or 5%, excuse me. So in this case, I need to calculate what my purchase discount is. So I need to take 5% of my original price that I purchased the items at, okay? Why am I not taking the entire amount? All right, so think of it this way. Can you go up to FedEx, or in this case, UPS, and say, I want a discount on shipping? Can you go up to them and say that? Can you demand a discount on shipping?
No.
No, you absolutely cannot because shipping is its own separate rules and you have to fit those requirements, right? It's based on weight. It's based on the size of the box. It depends on what those items are. Are they fragile? Do you need to package them with extra stuff? So in this case, right, you are not able to take a discount off of shipping. So that's the same idea here. If you can't discount shipping in any way of cost, right, because you are the one who told the company that I need these items at my store. So you had to pay for the shipping as a separate cost. So that's exactly the same idea here is you can't take a discount off of shipping. So that's you can only take a discount off of the original purchase price. So in this case, each cup was $1.25, right? We purchased 100 of them, so $125 is what we can discount, okay? So we can only discount 5% of the $125, which gives you $6.25. So that means you're going to pay $6.25 less, and you're going to cut a check for $218, okay? All right. So in this case, because we have a purchase expense going on, this is where you're going to be learning that a purchase discount is a contra account. It's going to flow in the opposite direction because you're discounting your purchase expense. Okay, so you're going to have to create a contra account for the purchase discount, which is going to decrease the purchase expense. Okay, so that's a little fun fact there that you need to know, that you have to create a purchase discount account. Okay, a contra account. That's why instead of debiting your purchase discount, it's on the credit side because it flows in the opposite direction. Okay. So any questions here in regards to the gross method? It's a condition that must be met, so you have to pay within a certain amount of days in order to get the discount. So any questions here? Okay. So then let's say scenario 2. Well, what happens if I end up paying on the 15th of February? Since the bill was received on February 1st, they gave me 30 days to pay for the entire thing, right? So I have until the next month to pay it. But in this case, what if I end up paying it on February 15th? Now, in this case, they gave me my incentive was within the first 10 days. I've already missed the 10-day mark. I missed it by 5 days because now it's February 15th. So how do I pay this vendor off? In this case, you're going to recognize that you owe them $225 and you're going to simply just pay them. Because in this case, you missed the discount opportunity. So in this case, whatever you recorded that you owed them is the amount that you're going to pay for it. Okay? So that's the idea here. Even if you didn't make the discount period, you still have to pay your vendor at one given point in time. So in this case, I have until 30 days to pay them. So I choose to pay on the 15th of February. So in their case, this is exactly what you have to do. You just have to recognize that you're going to pay for what you owe, right? No discount is claimed. Okay? Simple and straightforward. Okay? So what about the net method? Okay? So the net method, actually, the incentive and the idea behind the net method, once again, is for companies that have a lot of money that says, I can just go ahead and pay for it. So this is a way that they can save a journal. Because as you can see, right, for the gross method, we recorded at regular price. Then we recorded that we took a discount off. And then that was it, right? This is another way to just say, I'm going to save myself a journal entry by not recording the discount later, but I'm going to record it now. Because in this case, this company is looking at this bill and saying, well, I'm really good at paying my bills on time. And in fact, if they receive this bill, I can pay within the next couple of days. So that's the idea here that most companies would do. Instead of recording them at regular price, I'm going to record them at the discounted price. So this is how you're going to record it. So we already know that's the same exact scenario. Only difference is that we're using the net method to record it. So if it's 100 coffee mugs at $1.25 each, which give you 125, that's going to determine that my discount amount is $6.25. So what I do here is I am going to record the purchase expense at the discounted price. So therefore, I'm recognizing $118.75, and I'm recording the freight as a separate charge of $100. So therefore, I owe $218.75. Okay, I record the items at the discounted price, even though I haven't paid them yet. Okay. So then when the time comes, so now it's February 9, I go ahead and pay for them for what I owe at the discounted price. right? I don't have to figure out my purchase discount because I already included it in the very beginning. I've already discounted my items already. I don't need to put in a purchase discount account on there. It's already been taken into consideration in that I purchased them at the discounted price. Okay? Now, what happens if you accidentally miss that date? Then what's going to happen is, and if you recorded with the net method and you completely forgot, and then when you realize that you forgot to pay for this bill, unfortunately, you're going to have to correct it. How do you correct it? Well, in this case, you're still going to recognize that you owe $218. However, you're going to be creating an account called the purchase discount loss, which is a contra account. Okay? Because the idea here is you are supposed to record your purchase expense at full price, but no, you decided to purchase it at discounted price. And the fact that because the condition was not met and you failed to pay within the discount due date, now you need to correct it by putting in a contra account, which is a purchase discount loss, right? A contra account, right? One contra tells me it goes in the opposite direction. So this is a contra account. So this one is going to decrease the purchase discount. So in this case, it's going to flow in the opposite direction again, which converts into a debit. Okay, so you go from debit to credit to debit. Okay, so in this case, because you were unsuccessful to get the discount, so now you need to put the discount back into the purchase expense and then pay for the entire amount at full price. Okay, so yes, it can happen. So that's why usually the rule of thumb is maybe you shouldn't be too hasty to use the net method if you're not really good at paying your bills on time, okay, or early. So best recommendation is usually net method is more commonly for companies that have the money that can pay right away. Because again, you're buying in bulk. So think about it. If it's $1,000 order for a company that has the money that can pay for it, they're more likely to use the net method because they want to save the extra work of having to record an extra entry in there. Whereas for companies that are starting up from the beginning, most likely I would recommend you to use the gross method because you won't know how much money you will have at the end of the day. And if you do pay, right, then you'll, if you do end up paying for within the discount period, then you recognize the discount then. But most cases, again, smaller businesses that start up, they have other priorities. They have to pay the rent first. They have to pay their employees first. So a purchase expense for buying inventory might not be priority. Okay? So any questions between the two different methods that we just took a look at? Okay. So here's a chapter review where we talked about what the cost of goods sold is. It's right. It's the entire cost of the inventory, including any other cost. So remember, it's the total amount of cost it takes to get the asset to the store. Okay. We talked about two tracking methods, periodic and perpetual. So here's a little quick overview of what they do. Right. This is an example of how you record a periodic inventory purchase. Right. Purchase expense, freight expense, and then if it's on an account. We talked about the two different shipping methods and how the transfer of titles are being transferred and who is responsible for what. Okay, and then we talked about what happens when you have a discount, right? We talked about terms, right? Terms are a condition that must be met, and it's determined by payment. And we talked about the net method versus the gross method, right? So there you go. That is chapter 5.1 and 5.2. So let's go ahead and go over the exercises. Any questions in regards?
No.
What was that? Any questions?
No.
Okay. Norman, any questions?
Yeah, I was wondering about the freight on board
Okay.
and the seller store, cash on delivery, buyer store, the shipping point and destination, the buyer pays and the seller pays. Um, so, for example, the seller store,
Mm-hmm.
it says the buyer pays. So that means like something like Amazon, you would pay for the shipping and handling.
You would pay to get the product from the seller store to the midway point. Okay, that's the buyer's responsibility. So again, let's say I'm purchasing an item and it costs $5 for shipping, right? That's me covering from the seller store to the midway point.
Not to your door.
No, because once it gets from the midway point to your door, the seller is responsible. So
I, for some reason, I thought the shipping and handling to your door was paid by the buyer.
no, it's from the seller store to the midway point. Why? So for instance, if you're responsible from the midway point to get to your house, right? That means you're going to be responsible for it. So if the package is lost, Amazon can't do anything about it because you're paying the shipping between the midway point to the store. I mean to your place, right? That means you're responsible for it, right?
Can you give an example?
An example,
Yeah,
so of buying something and you're paying for you're responsible for it.
yeah.
Well, I already gave you the example earlier today. If you're gonna buy something from Amazon, right? You're paying the shipping to get it from the selling point, the seller's store to the midway point. You're responsible for that part.
But what is the midway point?
It will depend on where the product is coming from. So again, if it's from an Amazon hub, right, then your point is to get the item from whoever's is shipping it out to the Amazon hub. So you're
Oh,
paying whoever is selling the product to get the item to the Amazon hub,
okay.
right? And then it's Amazon's responsibility to get from the Amazon hub to your house. Yes? Shipping is a
Um,
two-way process. It's not just one. Okay, that's why shipping is going to be one of the most expensive things that a lot of people pay for. But here is the actual breakdown is that you're not responsible to pay the entire shipping from point A to point B. You're only for point A to the midway point, and then from A to B is going to be, it's a two-part shipping. So again, shipping, you're only responsible to pay for the item to get to the Amazon hub. Then Amazon is responsible to pay for um, the mid from Amazon hub to your store. So again, for instance, right, shipping could be paying the truck the gas to travel to get the item to your store. Is that not a separate cost to the business for Amazon?
Yes.
Right. Because they're responsible to get the product to you. So how are they going to get the product to you without incurring any expenses? Yes, they bought the truck, but don't they have to pay gas for the truck to get from one location to another?
Yes.
That's considered an expense, and that would be considered a freight expense because it's shipping. It's literally shipping, whether it is via vehicle, airplane, train, however it gets the package from one location to another is considered shipping.
And then that's the way we actually know who has the package
Correct,
being
right?
delivered.
Correct. And who's responsible if you don't get the package?
The shipper,
Exactly, which is Amazon, right?
right?
So if Amazon loses your package, you can go ahead and complain and get your refund back because it was their responsibility to get the package to you. And if they
Mm,
failed to do it, that's on them,
yes.
not on you. Because you've already done your job by paying the shipping to get the item to the midway point. So in this case, if we're using Amazon, you're buying and you already paid the shipping to get the item to the Amazon hub. Okay, because again, not Amazon hub doesn't hold everything, right? Some certain sellers have to ship those items to the Amazon hub. Amazon might not have it available at their store. Right? And how do we get the stuff, how do we get the items to the Amazon hub in the first place?
You have to pay the shipping.
Correct. It's already been pre-calculated and pre-planned. So in this case, those items are they're already shipped into the Amazon hub. And who's responsible to pay for that is going to be you. Okay? Does that make more clear sense, Norman?
Yeah.
Okay. So any other questions?
Well, they usually send you like a tracking number,
Mhm.
so that's how you can find who is delivering your package.
Mhm. Now again, there's of course with technology, everything's with a barcode now, so we have easy accessibility to do that. But oftentimes, again, there's always that time. There's always going to be that one person that they failed to send the package. Oh, it got lost in the mail, or it got lost at UPS. Right? It happens, and that's why at the end of the day, who's responsible for it? At the end of the day, the company is going to be responsible for that mistake anyway because they
Okay.
want to guarantee customer satisfaction. Right? Any other questions? All right, let's go ahead and do the 5.1 and the 5.2 exercise here. So we won't be doing 5.2 because discounts. We'll talk about discounts when we get into the chapter 5 exercise. But in this case, let's just practice journalizing for 5.1. Okay? So number one, journalize and assume that all purchases were made with cash. Okay? And then here, so April 5th, we end up purchasing 1,000 units at $5 each. Freight cost you $100. So in this case, how would I journalize this exact transaction? And using periodic inventory.
Okay, that would be 5,000.
Okay, what account am I going to be using?
Accounts payable.
Not accounts payable. How do I record that I'm purchasing periodic inventory?
Okay, that'll be a purchase expense.
It would be a purchase expense, correct. So here you go, purchase expense, right? For the total amount of, you said 5,000, right?
Right.
Good, that's correct, right? We don't put 1,000 in our journal. We only put the total cost value. So in this case, it cost me in grand total $5,000, right? What else do I need to recognize?
The freight expense.
You need to recognize the freight as a separate expense to the company, right?
And that, yes, and that would be 100.
$100. And how did I pay for it?
Uh, by check,
Now in this case it says cash, right? I paid,
cash.
yeah. So in this case, that's exactly what I'm doing. I'm decreasing my cash flow, and for what total amount?
5,100.
Mm-hmm. So that's the idea there. So again, in this case, yes, you wouldn't have $5,000 in cash. You would normally write a check, but in this case, I just want to get the concept down. So in this case, right, to finish off, I'm going to also write a description, right? I'm going to say that I purchased 1,000 units at $5 each. Okay? Right? Now, in this case, you don't have to say specifically the shipping cost you $100 because right here, I've already identified that I had a freight expense, which is normally freight is known as another word for shipping or something like that, okay?
Okay.
So in this case, I don't have to reiterate or put in my description something that's already obvious. I only need to know why is my total purchase expense at $5,000. Well, in this case, that's because I purchased 1,000 of them at $5 each. So that's something that you have extra information that you should, unveil. So then you're able, so people, when whoever's looking at your journal can recognize how this happened, why it happened. Okay. All right, good job for the first one. So the second one says April 10. We end up purchasing 750 units at $5.75 each with a freight cost of $75. Okay. How would you journalize this?
Okay, that would be purchase expense.
Mm-hmm.
And I believe that's like $431.
Okay, let's see. Purchase expense. Okay, so let's go ahead and do the math real quick. Okay. $5.75 times 750 will give you 4,312.50. Okay. What else do we need to recognize?
Freight expense of $75.
Okay. So how much total cash am I going to be paying for?
4,387.50.
Good. Right? And here I'm also going to make a note here that I purchased 750 units at $5.75 each. Okay. All right, so let's go ahead and do the last two here. Okay, so on April 20th, you end up purchasing 200 units at $6 each with the freight costing you $20. So how do I journalize this?
Purchase expense.
Okay. So in this case, what you're going to notice is that it's going to be same entry. Only difference is numbers are different. So purchase expense.
1,200.
Good, right? Because I purchased 200 units at $6 each. That gave me $1,200. And then freight was $20. Excuse me. So $20. So in this case, how much is going to be my total cost?
$1,220.
Good, right? And make my note here that I purchased 200 units at $6 each. Ooh, excuse me. Okay. Last but not least, April 25th, we end up purchasing 500 units at $6.25 each with a freight of $50. Okay. So purchase expense, right? I purchased 500 units at $6.25 each. So
31.25.
okay. $31.25.
Mm-hmm.
Right? And then my freight cost was $50. Mm-hmm. So how much total cash am I going to be spending?
31.75.
Good. And then last thing here is that I purchased 500 units at $6.25 each. Okay, good. See, now you're noticing, okay, it's a trend, and that's what we got to do is every time you make a purchase of periodic inventory, that's what you have to recognize. Purchase expense, and if there is any freight expense, and however you paid for it, whether it's cash on an account. Okay. All right. Number 2, okay, what costs are included when making a purchase for inventory?
Shipping,
Shipping. What else?
freight,
Freight. Okay, we already recognized that one. So shipping and handling in case you have fragile materials. What else?
Now discounts.
Um, discounts are going to be considered conditional. So it's not going to always be included in the actual cost of inventory unless you meet the condition.
Okay, because some stores uh, offer a discount for like when you do your order. Sometimes you don't have to pay the shipping, but you will be paying the tax plus whatever else.
Okay, so for that example, right? Because the amount of merchandise that you purchase could automatically cover the amount of the tax, right? Or in this case, or the amount of the shipping, right? That's going to be some
Right.
of those one of those deals where yes, now that's not because you know you're not paying for the shipping because at the end of the day, the company still has to pay for the shipping to get to your store. The
Right.
idea is that just because you bought enough merchandise from them that they said
Mm-hmm.
it's going to cover that cost anyway because they're probably shipping to multiple locations, so the more that you buy, that means the less
Yeah.
shipping that they have to be responsible for or to
Mm-hmm.
get from you. Now that is not going to be considered a discount per se. Now in that case then you would be calculating the discount immediately, wouldn't you? That would be the net
Mm-hmm.
method. So is that going to be considered part of the cost? It can be, but again, it's a condition, right? You have
Right.
to buy a certain amount in order to get it. So I wouldn't necessarily put that as a one of the items that would be considered as part of the cost because it's a condition that must be met. So you may or may not have the opportunity for that. It just depends on the company policy, right?
Mm-hmm.
Now, what about sales tax,
Yeah.
right?
You'll be paying sales tax.
Depending on if they
storage,
charge you, right? If you go to the store, 100% you're going to get charged sales tax. Now, if you have a good relationship between your supplier and you, right? They might tax exempt you because you're going to be collecting tax for them. So they don't need to be responsible. They're transferring the title to you to collect the sales tax from the customer and hold you accountable for making payments to the state instead of them. So that's the idea that they could transfer the title over. We call that use tax. All right. So again, you can be taxed, you can be not taxed, right? So in this case, there is an actual definition for this one, right? It's all costs it takes to get the inventory asset to your store, right? Which includes shipping, handling, foreign costs if you're shipping it from overseas, expedited costs if you need that item within 24 hours, right? Sales tax if it needs to be charged. So again, those are going to be examples of what extra cost it takes to get the asset to your store. Okay. Number 3, okay, what are the 2 tracking methods of inventory?
Periodic,
And
perpetual.
good. So periodic, and then perpetual. Good. Okay. Now, what does net method mean?
You take the discount immediately.
Yes. Take discount immediately. Okay. And then here, number 5, using the gross method of periodic inventory. If you made a purchase of on April 5th, okay, of 1,000 toys at $5 each, with the freight costing you $100 on an account. So there you go. There's a difference here. And of course, the vendor gives you terms of 5% 15 net 30. Okay, so journalize this transaction. So in this case, I want you to go ahead and journalize the gross method of this purchase of inventory here on an account. So today is April 5th, right? How do we acquire our inventory? Using the gross method.
Purchase expense.
Purchase expense. What else do we need to recognize?
Shipping expense.
So we call that
Freight expense.
mm-hmm. Okay. So how much is my total purchase expense? If I purchase 1,000 units at $5 each.
5,000.
Okay. And then how much was my shipping and freight?
100.
100. And here's a new word. I placed it on an account. So what account am I going to recognize that I owe a vendor money?
Accounts payable.
Correct. Accounts payable. Okay. So again, that is 5,100, right? You owe 5,100. And of course, you could put, right, that you purchased 1,000 units at $5 each. Okay. And if you have it on an account, now the account terms gives you a opportunity to take a 5% discount if you pay within 15 days. If not, the bill is due in 30 days. Okay.
Right.
All right, so then since number 6 is here, continue with the question 5. You paid the vendor on April 15. Journalize this transaction. So in this case, it is now April 15. And I'm making a payment. If they gave me terms of a 5% discount within 15 days, did I meet the discount due date or did I miss it?
You made it.
You made it. So now that means I need to calculate what 5% discount is going to be. So in this case, today's the 15th, right? There's a condition that must be made. I have to pay, right?
Right.
So in this case, right, what first thing we're going to recognize is what you owe. Well, in this case, how much do you owe?
5,100.
Right now, I originally recorded that I owe 5,100, right?
Right.
But I now need to, since I'm going to make a payment, right? I have to now recognize,
Purchase discount.
which is a credit because it's a contra account, right? But I also, at the same time, I also have to recognize that I'm going to pay. So it's whether with cash or checking, whichever one, right? You're making a payment. Okay. Now the question is, how do I calculate my discount? Which number am I going to take 5% off of?
The 5,100.
That includes shipping. Can I discount shipping?
I believe you can.
Again, when you go to the UPS store, can you say I want a discount on
Oh
shipping?
no, no, no,
No, you
no.
can't. It's a matter of how big your package is, how heavy it is, and what box size, and if you need to, add extra stuffing to keep your items secure. So in this case, no, you cannot take a discount off of shipping. Okay? So what can you take a discount off of?
Your purchase price.
Good. So in this case, how many items did I buy for what grand total amount?
$225, $255 discount.
So how did you calculate that number?
I did 51 times 0.05.
Right. Okay, you mean the 5,000, not 5,100.
Okay, so it's 5,000.
Yeah,
Okay.
5,000 because that's the original purchase price, right?
Right,
And you multiplied it by the 5%, right?
right.
And that gave
So that's
you
$250.
good. So that's a $250 discount. So that's exactly what I'm going to recognize here is I'm going to discount $250. So then how much do I actually have to pay?
$5,100 minus
That's okay, 5,100 minus
250.
mm-hmm
5,000. I mean 4,850.
4,850 is what you're going to pay because you made the discount due date. Right?
Mhm.
All right. So, number 7, using the information from question 5, journalize the purchase using the net method. So, again, we're going to ignore the payment there. So, I want you to journalize um, question 5 in terms of using the net method. Right? So in this case, I purchased 1,000 units at $5 each, okay, with a freight cost of $100, and my terms are 5% 15 net 30. So how do I record this using the net method?
Okay, you will be doing purchase expense.
Okay.
Okay, will it be the 48.50?
Now 48.50 includes shipping, doesn't it? So what can I discount?
It would be the 5,100.
5,100. Okay, so in this case, right, the $100 is to shipping.
Right,
So how much I can only take a discount off of the original purchase price, right?
right. So it'd be the 5,000.
5,000. Right. So what's 5% of 5,000?
Okay, $250.
Okay, so if I can take that off of my purchase price immediately, then how much is going to be my discounted items? What's the price of my discounted items? Am I paying $5,000?
No.
No. How much am I actually paying?
Okay.
So 5,000 minus 250.
4,750.
Okay. How much is the freight?
The freight is still 100, right?
Mm-hmm. Okay, so then how much do I owe in grand total to an account?
4,850.
Correct. And that's how you get the 4,850, right?
Right.
Because in this case, $100 is the shipping, and you can only discount the purchase price. Okay. And then last question here is number 8. What does terms of 2% 10 net 20 mean?
You'll be paying 2% if you pay within 10 days.
So what is that? What do you mean you'll be paying 2%?
I mean, you'll be taking 2% off your purchase price.
Correct. So you
If it's,
take 2% discount if you paid within 10 days. If not, what happens?
you will be paying the full amount on the 20th of the
Not the 20th, but 20 days.
20 days.
Mm-hmm. This is a standard one. So what do you mean days? So upon receiving your bill, so for instance, right, I purchased it on the 5th of April, right?
Right.
If I was given this exact terms, right,
Mm-hmm.
2% 10 net 20. I'm looking at how many days upon receiving the receipt, which is the 5th, right? Because it
Right.
tells you that you bought the items this day and you charge your account this day. So therefore, I have exactly 10 days from now to receive that 2% discount. If not, I only have 20 days to pay this entire bill off.
Right.
Okay, if not, pay in full in 20 days. Good. All right. Awesome. Any questions so far in regards to chapter 5.1 and 5.2?